right, man. Let's just get it going. Okay. Episode 8. So I want to just give you credit.
Okay.
I feel like I got to give credit where credit's due. You are a very quick learner, right? I just want to point that out because I remember we're 8 episodes in.
Okay.
I think it was back on episode 2 or 3. I gave you a hard time about, saying, hey, thanks for having me and all this. And I'm like, hey, we're a partnership here.
Yep.
I think it's been like 5 or 6 episodes, and you have not said thanks for having me.
Yeah.
So you've really done well.
I mean, you only had to tell me one time.
Yeah, I scolded you in front of everybody.
Yeah.
And it worked.
You can tell my wife that, just
all you
one
gotta
time.
do is tell Jason one time.
One time, and I automatically change.
And he listens.
Yeah.
Maybe it's the tone.
Maybe.
I don't know.
Yeah.
But
I don't think she'd agree with you.
we won't tell her.
Okay.
And she's definitely not going to listen to this, so it's fine. So
I'd like to think maybe she'd listen to my podcast. I don't know.
Don't listen to episode number 8. Hey, today I am excited about this one. Path of money.
Yeah.
Path of money. So money demands an owner that puts it to work, right? I mentioned it before. If you haven't read it, The Richest Man in Babylon. Awesome book.
It's a great book.
It's a great book. It's a parable style type read. I love it. If you can get over like how they talk, because it's like it's written back in the Babylonian days and everything. It's written like 1920 by George Clawson, but I love the book. But it talks about that money demands an owner or a master that puts it to work. And if you don't put it to work, it'll find somebody else that's going to use it properly.
Yep.
So, we're going to get into how money works and everything like that. I was thinking as we were kind of prepping for this show, my biggest regret, my wife actually asked me this a couple of weeks ago. My biggest regret when it comes to finances is, we talked about I've lost a whole bunch of properties and everything. That's not even my biggest regret. My biggest regret is I've been so consumed in my life with making more money, but I think that came from I wanted more stuff.
Okay.
Right? Instead of putting money to work to buy back time, right? And give me more options.
Okay. Yeah.
So today, and in the last few years, our mind shift has completely shifted to, okay, how are we going to put our money to work for us so that we eventually don't have to work for money?
Yeah. I think we had talked about that. You had asked me, what is my definition of wealth? And I usually tie it to time. And those that are wealthy have tied that aspect to that instead of material possessions.
Yeah.
And so you could want that time for various reasons, but that's what's important to me as well. So,
yeah. So when it comes to, the pathway money and everything, so just looking at our notes, you talked about earlier on in your life, money was all about money coming in, money going out.
Yep.
So kind of explain where you came from and.
Well, I think my mindset growing up was the same as the majority of Americans. I worked a set amount of hours. I earned so much per hour for those hours. I got so much every Friday, or the other majorities of people get a paycheck every single 2 weeks. And based on what that number is, they either decide, I can make it for these 2 weeks if I spend the money here, or I won't be able to go the 2 weeks, or I'll have to go without something for these 2 weeks. And that's the way it was. Money in, and that same amount of dollar was out.
Yeah.
There was no above and beyond. There was no savings or anything. And I'll say we honestly, both of us brought that into our marriage as well. I mean, that was kind of our mindset. Nobody ever talked to us about saving a certain portion or investing or making our money work for us. And unfortunately, the majority of Americans have the same influences as well.
Yeah.
So, I mean, Allie graduated college. We got married. Of course, now our income grows. She started working. And so the first thing we did was go out and buy her a car. I mean, that's just one example of, okay, instead of working part-time, now you're working full-time. we're going to go out and we're going to buy a car because, right, our income's doubled. So now we'll just spend, I don't remember what the car payment was back then, $500 or $600 more a month. The money's there, so we'll just go spend it. And yeah, we brought it into our married life until somebody got a hold of us and started talking to us about thinking about the future, looking at things from a business perspective, thinking about an entrepreneur, all those type of things. It was never a thought process before that. So,
and it's funny because even in marriage, one person can be at a different part in their life and what they're thinking about than their partner, right? Yep. So, like, just to be transparent and honest, Ashton, when I met her, she was 18. I was 25. She was my bank teller and saw all the money that I was making, and then she just fell in love with the money. That's a complete lie. But anyway, so, I mean, that's to say that she's 7-8 years younger than I am, right? Mm-hmm. And so here I am, I'm 41, she's 33. What I look for and what I'm preparing for and thinking about is, my future years and then generational wealth and everything like that. And, sometimes it's frustrating for me because it's important to her, but she doesn't think about it as much as I do. Yeah. And then I have to realize, well, I wasn't thinking about it when I was 33. It wasn't even on my mind, right? I was living just like everybody else, like you were saying. I mean, you just live the American way. Yep. And so that's taken some patience on my end of kind of understanding that even though it's important to her and she doesn't think about it as much, it's not that it's not the same amount of importance that it is for me. Mm-hmm. It's just we're at two different stages in our life. And part of that's because of the age gap that we brought into the marriage. So, but now when it comes to money, so there's basically, when we get into the meat of this, there's two types of capital, right? There's human capital and there's capital assets, right? Human capital, what we talk about is money that you actively have to go out and earn. Mm-hmm. So you're trading time for money. Yep. Right? Most people go get a job and your boss says, "Hey, I'm going to pay you $15 an hour." Well, you just established that your worth, right, that you've put on yourself by taking that job is you're worth $15 every hour that you work. Yep. Right? And so that's human capital that we brought in. We eventually want to get where our capital assets, so our passive income, our money that's making money itself, is expanding to a point, and we mentioned it before, where our passive income exceeds our active income or what it takes to pay the bills, right?
Yep. Another way to think about that is, your passive income exceeds your monthly expenses, what it takes to, and if that is the case, passively you're earning more than what your monthly expenses are, is you could walk away. I would never, encourage anybody to completely walk away forever, but let's say this is buying back your time. If you want to go on vacation for a week with your crew, then go with your wife and your kids, and that income is continuing to come in, and that's bought you an entire week of memories, time with your kids. I would argue that's when you have become financially free.
Absolutely. Yep. And this podcast is called Wealth Without Stress, right? Mm-hmm. And we've talked about many times on this podcast about creating options for yourself. Mm-hmm. And if you get to a point where you are financially free, you have the option to walk away. And you might be in a job that you really love, and it fulfills you and brings you passion and everything, and you don't want to leave. But you might also have the option to just say, "Hey, I love what I do. I want to be a part of this organization. I just don't want to be here 40 hours a week. Maybe I want to be here 30 or 20 and give more time to my family or other things that are meaningful in your life," right? Start volunteering more, everything like that. So like for me, my ideal life, once I reach that pinnacle, right? I have a goal in mind that once I meet financial freedom and I get the airplane that I want, there's organizations out there, they're called angel flights. And so they're giving free flights to kids that are going through chemo treatment, have cancers, leukemia, and all that kind of stuff, and they can't travel a long distance in a car, and they need to travel much faster. So private pilots are giving up their time and providing rides and paying for it out of their own pocket and taking these kids up to Kansas City, to Denver, or wherever, right? And so that's kind of a deal that I want to be able to do and be able to not rely on, making an income, but having passive income, provide for that kind of life to where I can do those things in society.
Yeah. Well, money's a tool, and it takes money to be able to do those things. It takes money to be able to buy the airplane. It takes money coming in passively for you to be able to take a week away or even a day away from actively making income to be able to provide that amazing blessing to a family. And we shouldn't shy away from that. That is what it is. That's the way life works. And unfortunately, I've seen too many people make decisions that negatively affect their family is because they can't not go to work that day. It's either I go to work today and be able to continue to pay for the house and food and all those type of things, or I don't go to work today. Yes, I got to go to my kid's ball game, or yes, I got to go to the kids' field trip or something like that, but it's going to make a financial strain on the backside. And I hate seeing people have to decide between two good things.
Yeah.
And so,
it always goes back to the question, if money was not an object or money didn't matter, what would you do with your life?
Yeah.
Right. And so that's what we want you to start thinking about.
Yep.
So any type of capital that we bring in, whether it be human capital from our job, active income, or from our capital assets, that creates cash flow.
Yep.
Right. Money coming into our world and into our bank account, that's cash flow. And there's really only 4 things that we can do with that, right? So we can spend it, we can donate it, we can save it, or we can put it to work and invest it. Right? And so when we decide to spend it, that's what most people spend their money on are living expenses, right? The house, the cars, utilities, food, right? And so there's a certain aspect of that's a necessity. We have to have it, right, to survive. Now, do we need the $75,000 AT4 like I got? No. Right? And, I question even today, do I get rid of the truck and get something cheaper? Because it's just transportation, So, the more that we decide to spend, the more it's going to take away from doing the other things in our life. Right?
It's hard to tell people, but they just need to understand the truth. That truck in your situation is not causing you a financial burden.
No.
Okay. However, I come into contact with way too many people that love the truck, and just being honest, much more than the ability to be able to earn some passive income or to be able to save. Just being honest with them.
Yeah.
If things are that tight and you're having to work extra hours, whatever it is, to be able to pay for that truck payment, but you'd rather be spending time with your kids, I would argue that no, you really like that material possession more than spending time with your kids.
Yeah.
And so there is that just reflecting on those decisions that we make. And so, yes, I know that you may not be able to earn a substantial amount of income and you're literally being at the bare necessities and such. You're not able to save right now, but I'll tell you, there are ways, and it is unfortunately having to take some extra time and starting to work a 5 to 9 to bring in some extra income. But I will tell you, when the money starts coming in on that 5 to 9, after you've already worked the 9 to 5, this is how Allie and I got started, right? We had our 9 to 5 jobs or our careers. It wasn't enough to get us where we wanted to be, so we started a part-time business on the side. And we used the evenings, we used the weekends, we took time, right? And we started earning that extra income. None of that extra income went to buying more material possessions, all those type of things. It was a different flow chart than what we're looking at right now to come to you with this podcast, but it was the understanding that if we don't use this money for other things to start investing and saving changing our financial outlook, it's going to be the exact same for the rest of our life.
Yep.
So all of that extra on the 5 to 9 side of things went towards, like we shared last podcast, paying off debt and those type of things. Wasn't probably the best thing to do, but it provided more margin all the time. And then being able to create more cash flow, which created more time.
Yeah.
So we're going to get into that.
Yeah, absolutely. So another very important thing, being Christian and everything, when it comes to one of the 4 things to do, donating money and everything, I believe, in the tithe. Mm-hmm. And so that's where I like to, if I'm going to donate money, that's the very first place I do. So 10% of my income needs to be going to the tithe, right? That's what I've been commanded to do as a Christian and everything like that. So, but it could be to other things, right? It could be to important organizations that you're passionate about, right? But, and there's no right or wrong in any of this. It's, you just got to decide what percentage you want to do and what's important to you.
Yeah. I mean, I would argue that 10% is a minimum when it comes to a tithe. Anything above and beyond is just an amazing blessing to be able to do that. There was a mentor of mine that shared something with me, and it's been really, really impactful to this day. So, if you look at your hand, an open hand provides you the ability to be able to give. It also provides you the opportunity to be able to receive. Mm-hmm. And so if you're giving, I wholeheartedly believe that there's a principle that you also receive. Mm-hmm. But if you've got a closed fist and you're holding on, hoarding anything and everything that you're earning, you can't receive anything with that closed hand either.
It's hard to be blessed.
And so it's really, really hard. And then also the thought process of, if you're not celebrating other people's wins, it's very, very hard for you to also be able to receive, right? If that's your closed off mindset of not being able to celebrate somebody when your buddy, gets a raise at work or something happens to them, you've got to be able to celebrate that. If not, it's going to be very hard for you to be able to receive something, if you don't have that type of a mindset either. So you've got to be willing, and it may be, hey, I've got to sell my pickup to have some more time or to be able to start investing. Or I may have to let go of Netflix to be able to start working a few extra hours in the evening or something like that, or start cutting down on some of these things, keeping up with the Joneses to be able to move over to start tithing or start donating or start holding, saving and start investing.
Yeah.
It's just being honest. You've got, how important is it to you to change where you're at financially?
Absolutely. Man, that one hit hard.
Yeah. So I see a lot of those people online and stuff that, I mean, they hate it when somebody else has a win. And they've been struggling and wanting to have a win so bad. But, I mean, I'm one of the first ones to celebrate anybody. I'm like, man, that's awesome, you know.
Well, but it comes down to, do you have a scarcity mindset or do you have an abundance mindset, right? If you think that you are going to lose just because somebody else wins, that's a scarcity mindset, right?
Yeah.
You're not creating value in the world, because value comes from our imagination, right? Services we provide, services and goods and everything like that. Mm-hmm. And so just because if I win, I could provide a value to you and you could also win, right? Mm-hmm. You could partake in that. So start thinking of opportunities that you can take place in instead. And so I'm really glad that you brought that up, because it all comes down to mindset and everything. And I know that wasn't even in our notes and everything, but the envy that is going on, especially in the American society, it's running prevalent right now.
Yep.
And so
if you have a scarcity mindset, you think that there's like a finite amount of dollars.
Yeah.
And I laugh and I smile when I'm like, no, because the government's just going to keep printing more. So, there's no finite amount. I mean, they're going to continue to, so there's enough for everyone wholeheartedly.
The funny thing is, sure, there's a certain amount of dollars in circulation today, but I will, for one, like you said, the government's always going to print more, right? So that's inflation right there.
Yeah.
But do people understand that when they take a loan from the bank, they are then, the moment they sign their name, they are creating inflation, right? Because that bank, if you really understand how banks work, they are not lending money that they have on hand. That money's been circulating, and they only have to keep a fraction. That's why we call it the fractional reserve banking system. They only have to keep a fraction on deposit. So if everybody made a run on the banks and went to go get all the money that's supposedly in their accounts, there's not enough
There
money.
wouldn't be enough there.
Right? Most of our money is made up in digital versions of just numbers on a screen. Right? So you can create wealth. If a builder went and built a house, right? And he paid the plumber and he paid the framer and he paid the electrician and everything, and they all got paid. Is his house not worth what it's worth? Right? No, everybody got paid and the house is still worth. So he or she created value into the economy with that house while also paying all those contractors.
Exactly.
So yeah, you just got to find out where you can provide value and have that abundance mindset. I'm so glad you brought that up, man. So the next thing on, and it kind of goes hand in hand, you could either save your money or you can invest your money, right? Now, we're going to get into a couple of the, the different avenues of investing and everything like that, and probably what we should be doing and everything. I know Dave Ramsey's got his baby steps, and you should have an initial baby or emergency fund and everything. I'm all about the emergency fund, right? And so when we talk about investing money, right, there's basically two types of investing. There's passive and there's active, right? And so I definitely want to come back to that because that's what I want to spend the rest of the podcast on, talking about those two avenues and everything. But before we get to that, I want to look at some of because I know there's people out there listening right now, Jason, says, okay, I understand there's 4 things I can do with money, right? But they're very analytical and they're like, hey, how much should I put to each one of those 4 categories, right? And so I kind of was doing some research on it, and there's a couple popular budgeting formulas out there. There's the 50-30-20 rule, right? So when it comes to that, 50% for needs, 30% for wants, and 20% for savings. But if you notice, that's 70% in the spending category, right? And nothing's invested, right? And when I say invested, no money's been put to work because it talks about just savings and nothing's been donated. So you're kind of leaving out a couple of the buckets that we really need to be looking at, right? On that 50-30-20 rule. Another one is the 70-20-10 rule, right? 70% in living expenses, 20% in savings, and 10% personal spending. Well, if you still look at that, I mean, that's 80% in spending, right? There's no investing. There's no donating. So, and if you're just saving just to acquire money and acquire a pile of cash, you're really missing out on the wealth building aspect.
You do have your bare necessities. You have clothing, shelter, food. I mean, there's the bare necessities, right? And people are being able to take care of those. At some point, you cannot cut expenses any lower and physically be able to still have those bare necessities, those hierarchy of needs. And so I argue that if you've got your expenses down to a certain amount and it still isn't enough for you to be able to contribute to the save and the wants and all those type of things, it's actually going to be easier to start adding value instead of continuing to cut. And that's part of the Susan Orman and Dave Ramsey and all those problems is they just talk about cut, and not adding any value at all.
I'm so glad you brought that up because somebody that I've followed, and some people love him, some people hate him. And it depends on what video he puts out. I'm on either side of that. But Grant Cardone, right? So Grant Cardone, he is very in your face about his wealth and everything like that. But he talks about in his books, right, the 10X rule. He talks about how everybody is so on that Dave Ramsey, Susie Orman, everything. The wealth equation is your income minus your expenses equals whatever, right? He talks about how everybody is so consumed on cutting that they really should be on the income side of the equation. They should be focusing big time. Go raise your income 10 times, right? If you're making $50,000, figure out a way to make $500,000. Now I know I know I just lost a couple people, quite a few, because they're like, oh, there's no way. I could tell you, I've been at 50,000 income. I've been at 500, right? There's a way, and it's out there. If there wasn't a way, we wouldn't have people earning $100,000, $250,000 a month, right? So go figure out a way to create that value, right? So focus on that side of the equation, the income side.
And then once that income starts to come in, you're starting to add more and more value. Do not do the creep and start increasing your expenses.
And we talked about that the other day in the 5 steps of wealth, right?
Yep.
Where, you increase your wealth and then you maintain your living standard while investing the extra money.
Yep. Do you value that more than the newest gadget or whatever it is? I promise, if you don't have that instant gratification need, I promise it'll work out in your favor long term.
Before we move on, let's look at, the last popular budgeting model that I saw out there. And it's kind of the one that fits as closely as possible of what we're talking about, but it's the 60-20-20 rule. Now, if you notice, there's still only 3 numbers. So we have 4 buckets, but 3 numbers. So 60% into living expenses, and the remaining 40% gets split up between savings and investing, right? Which is, kind of what we want. But there's still nothing towards donating or anything. And it all depends if you're, like I said, if you're a Christian or not, and you believe in the tithe, or you have foundations that you want to support or anything like that, then, that's up to you. But so I guess talking about those budgeting models, and then talking about there's 4 things that we could do with money when it comes in. You could spend it, you can donate it, you can save it, you can invest it. Like, what's the perfect plan, right? And so I know there's people out there asking that.
Yeah, I don't know if there is a perfect plan. I would say the more you're able to be mindful in all aspects. So to keep your expenses into and there's other recommendations out there. They'll say your home mortgage should never be more than this of your income, whichever one of those you want to spend. But ultimately, that may say 35%. Well, you could honestly live at 20% of your income being your mortgage if you're content of that home being nice enough or whatever it may be, right? So, you get to dictate that. And I don't know if we could tell you this is exactly what you're supposed to do, because ultimately you're going to make that decision regardless of what we tell you.
Yeah.
What I would say is at some point you need to figure out, okay, my needs are taken care of. What are the other priorities that I have? Is it to start to buy back some of my time? Then I would say that percentage of savings and investing need to go up.
Yeah.
It's in direct correlation to one another.
So this is going to be completely out there from what you hear most people say. And I know there's going to be a lot of people that are listening to this or watching this on YouTube, and they're going to be like, there's no way I can do that, right? But if you ask me, for one, as a Christian, 10% should be in the donating right off the bat, right? From there, my living expenses, or what I think your living expenses is, so your spending category, should be maxed out at 50%. Okay? And so that leaves 40% for savings and investing. Now, when I save money, I'm saving first. I like Dave Ramsey's thought process of we're going to build the emergency fund first, right? Because that keeps us from having to rely on banks when an emergency hits, right? The last thing we want when things go bad, and we talked about it in the last podcast, when things go bad and we can't have, or we don't have a way to really pay back the banks, we're less likely to get the loan anyway. Yeah. So having that as the plan is probably not a good plan up front.
Well, or even a thought of that. Let's say if we invest anything and everything above and beyond that 60%, and then after tithing and all of that, let's say if you invest every single one of those dollars and an emergency does hit, I would hate for somebody to have a rental property and they have to sell that rental property because they don't have an emergency fund. That would be horrible for that thought process. So, I was thinking, well, hold on a second. I was going to push back about that a little bit, but that is true as I've thought about that. And I would say, having a save bucket, that's something that just that margin, that cushion that you're just never really going to touch, and it affords that emergency. So when you do start investing, you're not having to sell the assets to make up the emergency fund. So yeah, that's great.
Well, and this is why I don't really care for like day trading or anything. I don't like the idea now that, learning about money and how the wealthy do that, they don't sell their assets. And even, you can have some real estate investors that say, well, I'm going to sell a smaller property and everything. Well, Well, yeah, you're selling the smaller property in hopes to go get the bigger asset, right?
Yep.
And then we're doing other things like 1031 exchanges to defer the taxes.
Yep.
But we're not giving up completely having an asset.
Yep.
Once you own an asset, you want to keep that asset for as long as you possibly can, unless you're going to trade it in for an asset that's producing a larger return, right?
Yep.
And so, we definitely want to build up that emergency fund first. But after that emergency fund is built and we're feeling pretty comfortable and everything, and whether that's 3 months, 6 months, if you're self-employed, it might be a year's worth of an emergency fund. I don't know. But there comes a point where, okay, having just stores of cash doing nothing, we might want to look at, okay, is there a better place that we could put that? We talked about, a whole life policy, or shoot, even a money market account, at today's rates, earning 4%. I don't know.
Yep.
But do something with it. But other than that, once we have that, we need to then start putting our money to work, right?
Yep. So those aspects would be, okay, now we're actually going to look into investing. There's different avenues to invest. And I don't think that we want to go too much into recommendations of where you should invest and all those type of things, because honestly, you're the one that is going to take that risk. I can give tons of suggestions, but to be honest with you, I'm not fitting up the bills, and I'm not going to take the risk by telling you that.
Well, and here's a caveat. Don't invest in anything that you don't understand.
Yes. So I had heard, I don't know who it was, because I listened to a lot of things, but it said, there's no bad investments, there's only bad investors. And so if you're not educated in anything, I would say that's a hard stop. Even though it could be the best investment in the world and other people are getting whatever percentage and it would change your life, if you don't know anything about it, that's the best way for you to lose in that investment.
Yep.
You'd be the one person out of 99 or out of 100 to lose on that deal because you didn't think about the exit strategy, how it works, anything like that. And that's how and when people get taken advantage of.
Yeah.
And so, yeah, I think we can definitely give some thoughts, but in terms of a recommendation or something, I think being just wary of that. But if nothing else, hearing of these things from either lending your money, owning different assets, and then from there you go out and you research and figure out, man, that falls right in line with my personality. That falls in line with exactly the way I want to have my schedule work on a day-to-day basis. And I'm going to dive into that. I'm going to invest some money. I'm going to invest some time, all of that into that thing and learn to where I am successful when I finally do it.
Yeah. And one of the best, I always thought this was so cliche when people said this, but it's so true. Like the best investment that you can make is into yourself, right? And learning. Now, don't just learn to, hoard knowledge, because the whole knowledge is power thing, I think that's crap, right? Knowledge is only power when applied.
Yeah.
Right? That's what people miss out on. You have to go apply the things that you learn, or you're just hoarding knowledge, and it's no different than, not being able to read.
Yep.
I remember, and I'm not trying to get political. I'm not going to get political. We're a political-free podcast.
Okay.
Right? But I only say that because in 2006, I paid money to go to a Donald Trump investing seminar, real estate investing seminar. Right? $2,500.
Okay.
Right? And that investment seminar was enough to get me into a bunch of trouble.
Okay.
Right? Remember I said in 2008, I lost 76 properties. I acquired that course got me to where I had enough knowledge to go out and take action. Right? And it got me into doing deals and finding deals and researching deals. It's one thing to learn things out of a book. It's another thing to actually go out and apply it and learn from it and see the mistakes, and because that's when you're going to learn the most, right? Yep. From the mistakes. So I say all that, even though I acquired all those properties and I was making really good money and I lost it all, had I never taken that course, I never would have learned all the things during that period of time and all the lessons that came with it. And then I could take it a step further. In my 13-year career as a real estate agent, working with investors, I can honestly say that not a single investor I've worked with has ever lost money on a real estate deal that I've helped them with, because I've applied those same lessons with my clients, and I wouldn't let them do a deal if I knew it went against the lessons that I've learned.
Yeah. Yeah.
Right. But it all come from that $2,500 class that I took back in 2006.
Yeah. Well, what's made you so successful in the real estate space is the value. So going back to value, that's a value that the majority of other agents can't bring to the table.
Yeah.
Of going through that, having that experience, having that learning experience. They don't have that. So that's a value add. Those are the type of things we're talking about of on the 5 to 9 side of things, putting in the extra time and effort, the value add that you all as listeners should also be doing, right? Doing something a little bit different, adding value, and it will come back to you in the form of dollars.
Absolutely.
Yep.
So when we talk about, investing and everything, like we talked about earlier, there's 2 types of investing. There's passive and there's active.
Yep.
And really what we mean by that is the amount of time that we have to spend on it, personal time, right, to make it go. Now, I will argue that there's no 100% passive income out there. Doesn't matter.
If you find it, let me know.
Yeah,
call us and or send us a message at Wealth Without Stress and send it to us.
We would love to know.
I would love to know. Yeah.
If we could just give money and not have to ever worry about it and stuff comes in.
Yeah.
But you have to research it, right? You have to do your due diligence. And it doesn't matter what it is. And every type of investment by definition has risk.
Yes.
Right? And you could lose money, right? And so, when it comes to passive income, you could either lend out your money or you can own things, right, that are spinning off, passive income.
Yep.
If we're going to lend our money, what we're really doing is you're giving our money to like banks or something in exchange for a return for that money, right? So we're either talking money market accounts, we're talking CDs, we're talking bonds, maybe T-bills, stuff like that. Stuff that's, about as passive as you can get, right?
Yep.
Also, there's less risk with them. So less risk means probably lower rate of return.
Yep.
Right.
Yep. And I think it's important that you said lending. A lot of people don't realize the second they start depositing their money into the bank is they are now a lender. They are handing over control of that money. As much as you want to say my bank account, it's not your bank account.
Yeah.
The bank has sole ownership of those funds.
Your bank account just shows the liability that the bank owes you.
Exactly. Yep. So just understand that, and you can go research on your own if you want to go do that.
Yep. So the other part of passive, is owning things, and we're talking like stocks, right? And we can get into. I don't really want to get into whether single company stocks are good or bad or anything.
Yep.
I feel like anything that doesn't produce a dividend, in my mind, is just speculating whether it's going to go up or down.
Yeah.
Right. And nobody knows. Right. And so I kind of shy away. It's just me personally. It's just, it's outside my risk tolerance to own individual company stocks.
It's different if you own 51% of the stocks, like Buffett does. I mean, a lot of people say, well, he's in the stock market. Yeah, but he owns enough of the stock that he has a legitimate voting power and influence on every single one of the businesses that he is invested in.
Yep.
And you need to look at that. Where you don't, if you own 10 stocks or 20 stocks, you have no say or no control.
And he has enough market, I guess,
influence. He could literally sway an entire market
based off what he decides to do.
What
with
he
a certain
decides
stock.
to do, for sure. So there's a difference between him and you.
Yeah, absolutely. So we talked about stocks, REITs. I mentioned those last podcast, real estate investment trust. Now, I love those, and it's just what I personally like to put some of my money into because it spins off a really good dividend. At the same time, it's still a stock. So every day, that stock could go up and down in value. Now, I look at it as I don't care about the value of the stock. I take my active income, right, my human capital that I've went out and earned and worked for, made a commission on, something like that, and I've taken that active income and I'm buying passive income through the monthly dividend. That's what I'm concerned about. I don't ever plan on selling those stocks. So I can care less if it goes up. I can care less if it goes down. It's always going to go up and down. I just care about the monthly income that I'm getting from it. So other things we could do, mutual funds, something like that. What you got to understand, though, is those kind of passive incomes where you own things, you might own it. You might own that share of stock, but they control it. Somebody else controls it, right?
Has the influence.
And has the influence. So I don't have any control over what that company does. Those REIT companies do. I don't get to decide which building they go invest in. Right? So that's what you're actually doing. The other part of this is active investing, right? And so when we talk about active investing, again, you can lend it or you can own it.
Yep.
And when we talk about lending your money in active investing, what we're talking about is like owner financing, right? So me, if I have a store of cash and you found a really good rental property or a potential flip or something, I can then lend you money, create a note, a mortgage, right? And you could pay me and I can create, repayment plans, points, charge interest, all that kind of stuff. And I could be making money that way, right? And it could be whether it's a monthly payback or, hey, you got 6 months and it's just interest payments, or you don't make a payment. I get to control, right, how we set that up. So private lending, same thing. I can also own businesses. So I can create businesses or buy businesses and put you in charge of running my business, right? And so I have a more active role in it. I'm like a general manager or I'm an owner. You're more of like a general manager. You're the one that's running the day-to-day operations. I've just put the capital up and let you go do it. Right?
You're providing the value of paying the payroll of every single one of those employees. And for that value that you're adding to each one of your employees, you're also taking a risk of the capital of that business not being profitable, even once paying all that payroll. And so I've gotten, negative remarks from people about, all these business owners never paying their taxes, all those type of things. Well, they're the one that's taking all the risk. You're not taking any risk on this deal. And so, they should benefit from a profit of the value that they add to you, of your family, being able to provide food, shelter, all those type of things. But they are the ones actually taking all the risk on this deal. It's not you. And so, it's just trying to keep that in mind as well. That, there's a reason why business owners are able to exponentially start to build their wealth, is because they are taking that risk.
If I had it my way, and I know this is just a crazy statement probably, but I think if you're a business owner and you're providing employment for other people that are taking care of their family, that's an opportunity for them to make an income, provide for their family. I think as the business owner, I don't think you should have to pay taxes because you're providing that. But that's just my own personal opinion.
That could be an argument. That could most definitely be an argument.
For Congress. Yeah. Congress doesn't get anything done. But so let's get back into investing.
Okay.
So the last part, investing, and is one of my favorite, is real estate. So, putting your money into cash flowing real estate. If you're going to buy something, I don't know. I was going to say, if you're going to buy something and it costs you money every month, really, that's, in my mind, not a good way of investing. But I know there's people out in California and Florida, they don't play the cash flow game, and they're willing to take a hit on a monthly basis, and they'll lose $500 to $1,000 a month in hopes that in a year their property went up 150 to 200 grand. So I get that. I just don't like that.
I don't either.
Right? It's
too much speculation in there.
Again, regard. It goes back to speculation, right? You're
just
doesn't
playing, fit into my thought process when it comes to investing.
Or my risk tolerance. Right? When we look at the 4 buckets, so you can spend it, you can donate it, you can hold it, save it, right? And again, only up to a certain point. Anything over that's, you need to be putting it to work.
Exactly.
And then invest it. So what do I think's ideal? We shoot for never exceeding 50% of our income towards living expenses, right? We want to be investing at least 40% of our income. I learned that from Grant Cardone. He said, hey, I hate to be blunt, but if you're looking to spend, or you're looking to invest 10% on a monthly basis, don't be surprised when you don't have money in retirement to live off of, because it's just not going to be enough, right? And now if you get up to 40 or 50%, now you're starting to cook with oil, and now we can start talking. So once I heard that, I always shot for 40%.
Yeah, I think the proof is in the pudding in terms of, the standard is 10% of your savings, right? A lot of people are doing less. We've talked about that. I'm trying to think, for a lot of people, it's 7%, right, is what they contribute. And then the employer matches, and all these different things. So they're only saving 7. And I think we're realizing that if you just continue to put pennies in, you're only going to get pennies out when this thing comes up. And so, for you to realistically be able to live off of a retirement account, you're going to have to put more in, or you're going to have to start supplementing in some of these outside investments to supplement whatever may or may not be there in your 401k, in your IRA, these government plans. People are realizing it's not enough, and we've shared those numbers already.
Yeah. And, me personally, I want my investment income to match and then exceed my active income, right? So my goal, and I saw a chart of this in a book that I read long ago, but basically, as you get wealthier and wealthier and own more assets, a higher percentage of your income will come from passive income until you eventually get to 100%, right? Mm-hmm. Now you can still have a job and, maybe 5% is coming from your active income and a whole bunch of coming from your passive income. Mm-hmm. But you should always be trying to increase the percentage of your passive income. So that comes, it's called the velocity of money. Once you get to where, hey, we've gone through this path, money comes in, it creates cash flow, right? And then we've got 4 buckets. And then on our investment bucket, we put it to work. And then once that money goes to work, it produces an income, right? Mm-hmm. Which goes right back up to the top of capital assets, which is cash flow. And then it's more income, and we're going to put it in 4 buckets.
You got the next decision to make. How much of this increased passive income are we going to spend? Are we going to give? Are we going to save? Are we going to invest? And so, you can then start to go backwards if you're not making the right decisions. So, it's a constant flow, a constant path of money that we're dealing with here. Yep. So just because all of a sudden now, you were making 50, now you're making 100, you can be in the same spot you were at when you were making 50 if you're not careful. Yep. So it's got to be a consistent effort. But it's going to have to be a consistent effort. As you grow, you're going to have to grow in your ability to be able to manage as this continues to grow.
And going back to the 5 steps of wealth, right? Your active or your passive income needs to meet your living expenses. Mm-hmm. And then from that, additional income coming in from passive income is then only what you use to increase your standard of living, right? So we're not increasing our standard of living with the whole thing because, again, there's 4 buckets, right? We want to always be reinvesting some of that into future earnings.
Exactly.
And expanding that wealth.
Exactly.
So, well, this has been good. I'm going to leave this, obviously, for those that are watching this on YouTube. I got this chart on the screen so you can see as we walk through here. But, if you aren't on YouTube, if you're listening on Spotify or Apple Podcasts, well, Spotify, you can watch it. But if you're just listening to it, just Google the path of money, right? And look at this chart and then really study this chart. This chart, Jason, sits on my goal board in front of my computer screen in my office. So I'm looking at it every day, just as a reminder of what I need to be doing every time I earn a commission or anytime money comes into our lives, whether it's through investments or something. What's the path? What are we going to be doing?
Well, that's great. And I think, you have to have an ongoing thought process, the numbers out in front of you at all times so you know exactly where you're moving.
Absolutely.
So I love the fact that it's out in front of you all the time because if it wasn't, you'd easily lose focus of that.
Yeah. Yep. So, well, this has been good. Anything else you want to add?
I don't think so.
Pretty good?
Yep.
All right, man. So. Well, hey, thanks for being here. Hey, if you like what you hear, leave us a like. Help us out, subscribe to the channel. So I'm very happy with where we're at so far.
Me too.
So it's going great. We haven't really even got it out there. So it's been growing organically and we're starting to get some good feedback from people. I really love it. So until next time, guys, we'll see you.